Well, thank you everyone who's joined us in the room for our 2024 annual meeting for LEM Fund 5 and Fund 6, and also thank you for joining us virtually. I'm Jennifer Clausen, a partner with LEM Capital, and speaking with me today is Greg Biester, who will be back here in 1 second, and Allison Bradshaw. We also have a keynote from Jeff Adler, and I will introduce you in a second. We're so pleased to have everyone here and excited about our message today. A few weeks ago, I had the opportunity to moderate an institutional real estate panel of women. And our audience were undergraduate women and graduate women who were eager to learn about institutional real estate. And in preparation for the event, I asked my own 9-year-old daughter, "What are you most interested in learning about?" And her thoughtful yet very simple question was, "Mommy, why do you like where you work and why do you like your job?" And in reflecting on my answer to her question, it was a reminder of the importance of our core values here at LEM. I've been fortunate to work here for over 8 years, and the reasons I love what I do and where I work come down to these core values: collaboration, accountability, respect, and excellence. And these values aren't something that we just say, they're how we operate as a team. They're how we work with our operating partners and how we serve you, our investors. We take a very disciplined approach to the market and to managing our portfolio. Today, as we enter a new market cycle, we're confident in our ability to continue to build on the strong foundation and track record we've established over the last 22 years. Our focus remains on protecting the downside, delivering excellent risk-adjusted returns, and positioning ourselves to perform to the upside. This approach is one that I truly believe will distinguish us as we go forward. As deliberate investors, our strategy is very clear. We focus on bottom-up investing in an asset class that benefits from long-term demographic and demand drivers. 92% of our portfolio has exceeded our underwritten returns, and the vast majority of the remaining have met our expectations. Looking ahead, I think the next 2 years will provide a really strong opportunity to continue to invest in this asset class. We expect new multifamily supply will continue to slow. Stability in interest rates should build some more confidence between buyers and sellers. And with this in mind, we believe that entering the new market cycle will be a really good time to come back with our next fund. With our established track record and clear strategy, I'm excited to share how we plan to continue to deliver value to our investors. Thank you for your continued trust and partnership, and we look forward to discussing our strategy and performance in more detail today. Over the past 10 years, we have invested in 4 value-add multifamily funds. We expect to launch our 5th LEM Multifamily Fund 7 in the latter part of next year. Our target returns for these funds have always been 12 to 15% net IRR and a 1.5 to 1.7 net multiple. We are exceptionally pleased that Fund 3 and 4 delivered over a 20% plus net IRR and a 1.9 times net multiple. And we were really deliberate in selling a third of Fund 5 at the peak of the market. It allowed us to lock in some great returns for our investors, and I expect that that fund will end up at the high-end range of our target returns. At last year's annual meeting, one of our guests asked if we expected to adjust our target returns for Fund 6 based on the early performance for a couple of the investments we bought at the peak of the market. At the time, I felt really confident saying no. We have some more information on past and projected performance for those earlier investments bought at the peak of the market. And we're working to de-lever a couple of those deals and probably will hold them longer than we originally underwrote. As a result, we've made some slight adjustments to our expectations for the fund's targeted returns. We now believe that a net 10 to 12% IRR is probably a realistic scenario for Fund 6. But there's a couple things that could happen that could help us perform to the upside and get us back into that original target range. First, we are in defensive mode. On those early investments in the portfolio, we're being very conservative with our projections, which helps mitigate risk. Second, we are only 48% invested in that fund, of which 29% was acquired at the peak of the market. The current market conditions are creating attractive acquisition opportunities with pricing down from the peak in 2022. So we see a lot of potential as we deploy the remainder of that fund. Third, new supply is a near-term challenge in many of our markets, but we're already seeing new construction start to slow down. This should set us up nicely for some strong rental growth as that supply gets absorbed. And finally, we're entering a new market cycle, and that's historically the best time to invest. If we outperform on some of those later investments, we could see some really strong returns that exceed our expectations. These are our returns across our value add funds versus the Cambridge Associates value add benchmarks for our 3 vintage funds, Fund 3, 4, and 5. As you can see, they are mostly top 10% across all key performance metrics versus our peers. Net internal rate of return, net total value to paid-in capital, and net distributions to paid-in capital. Distributions to paid-in capital, or DPI, is a measure of the cumulative proceeds returned to investors relative to the amount investors have contributed. This metric portrays the realized profits to date that we have sent back to our fund's limited partners. All 3 funds have a DPI in at least the top 10%. Fund 5, which is not fully realized, remains in the top 5% in DPI and is ranked number 2 of 26 funds in its vintage. By comparison, the bottom 25% of the other funds has a DPI of 0. Just to be clear, we've sent 68% of the fund back to our investors, and other people have sent 0. Over time, I expect this metric will continue to improve as we restart distributions in Fund 5 by the end of this year. And also, I've had anecdotal conversations with other investors and consultants, and I think this is going to be a differentiator for managers going forward. Another way we evaluate our performance is to compare it to the appropriate public market benchmarks. And consistent with prior quarters, as of June 30th, your investment in Fund 3, 4, and 5 has earned returns that are superior to both the S&P 500 and the multifamily REITs. The instability we've experienced over the past 12 to 18 months has started to settle down. As you'll hear in today's presentation, values are ticking up, transaction volumes improving, and we're feeling much more optimistic about the opportunity ahead. We're also staying very focused on a few key priorities to help us manage the portfolio effectively and keep clear communication with you, our investors. Our goal is to ensure that you understand the reasoning behind our decisions and what we project for the future outcomes. Now I'd like to introduce you to our keynote speaker, Jeff Adler. Jeff is the Vice President of Yardi Matrix, the data division of Yardi Systems. And Yardi provides asset information for multifamily, senior housing, office, industrial, retail, and more. His leadership in real estate spans decades, including his role as Chief Property Operations Officer at Aimco, where he managed over 160,000 multifamily units, and co-founded the company's portfolio investment and asset management strategies. With a strong academic background, Jeff has a BA from Yale and an MBA from Wharton. And he also serves on the board of the National Multifamily Housing Council and lectures at Harvard's Graduate School of Design. With that, I'd like to welcome Jeff to the podium.
Thank you. Thank you, everybody. Thank you. Hi, how you doing? All right, so we're going to cover, I'm not going to do that. So we're going to cover a lot of ground today. Hopefully this thing works. Is it working? One more? Okay. So what I want to do is basically set a picture of the economy and also performance and how it's going to play out over the next several years. And then hopefully we'll have time for questions probably a little bit later at the end. And also I'll stick around for lunch. So please feel free to grab me. Okay. So just thinking about where we are with the economy. We are interesting session, not quite you, but kind of get of level of inflation handle on it, depending upon the metric you use. I'm using a GDP inflator. I was thinking the unemployment rate would tick up a little bit. Again, the latest report was pretty strong. On the other hand, the survey percentage was quite low, so the probability of restatement is quite high, and the sort of composition of employment has not been wonderful in terms of for the wealth-creating sectors. But I do see a reversion to an upward sloping yield curve at the end of 2025-ish, call it some. And so you're sort of getting things sort of like back on track from a financial standpoint. Really, housing, in terms of inflation, housing's the long pole in the tent. So if you pull out housing, we're already at a 1.7, 1.8 kind of inflation world. And housing actually has been the problem, and housing is not easily solved, and in fact, sometimes exacerbated by higher interest rates. And that's sort of an interesting kind of play, and has become sort of obviously a much more relevant issue. Housing costs went up much faster than was in the metrics. So inflation was much worse than depicted by the official metrics, and has actually become better as it has kind of pulled down. We have a lot of Federal Reserve banks who are our clients, and essentially the in-place rent roll is a much better measure of what actually is happening in terms of the official inflation statistics. One of the things that is a big deal in terms of the actual sort of functioning of the economy is deglobalization and the reshoring of productive capacity out of China slowly into Mexico, Southeast Asia, other parts of the world, and in the United States. And that is, again, we have food, we have water, and we have energy. And so you put all that together, the U.S. actually is a potential for kind of a significant renaissance of industrialization, not so much as employment, as much as productive capacity. And so that's kind of a big deal. You can see that with the CHIPS Act and some other investments in manufacturing. That's been a big deal. Now, when the labor market is not as tight as it was, but still historically pretty darn tight. If you go back to our current sort of labor market situation now, it mirrors that of 2019, and 2019 was the best labor market since 1969. So, you know, I think, again, people sort of forget kind of where we've been. We're a very historically tight labor market for demographic reasons, particularly, but the bottom line is the quits rate actually has come down some. So the thing, if you're looking at one of the best metrics of future inflation, if you look at the quits rate, it runs about 6 months in front of the ECI, which is the Employment Cost Index, which includes wages and fringe benefits. And that is definitely coming down tightly. And so we can definitely see that we're back to a 3-ish% kind of wage increase. And also, if you look at the productivity has actually spiked, and so unit labor costs are actually more like 1%. So you are setting up the conditions under which you could have good low inflation and sustained growth. So that's all kind of lines up with where the Fed does become to be in a position to move interest rates down over time. One of the things that is a little bit of an anomaly right now is the population growth has been decelerating and trending toward why we have a structural shortage of labor. We're seeing this, the spike in immigration is actually loosening up the labor supply at the bottom end of the economic scale. But let's assume that kind of, and I do think the social cohesion is kind of busted up, that probably goes away unless we have a long-range solution to immigration. We're likely to see population continue to decelerate. Now, if you look at this in terms of the labor force growth has actually moved from 1% down to a tenth to 0.3 of a point. So that is the basic nature of the sort of structural labor force. And when I'll kind of peel this back, if I have on the slide by age cohort, you'll see it's also very much a function. It's not labor force participation among prime age, but actually among older Americans who are moving out of the population. And so most of the immigration is actually from Venezuela, which has kind of collapsed. State-to-state migration is kind of back to close to pre-COVID norms. You kind of see the spike in the housing markets, which caused the movement of people. This obviously is COVID, and now it's the same level of migration is occurring, okay, in the same corridors, just at a lower pace, okay? So the same issues, the same, so if you look at sort of the Sun Belt cities, they still have the growth drivers, but not at the turbocharged levels that occurred in 21 and 22, which is truly ahistoric. Now, the one slide I didn't show in here is labor force participation rate by cohort. And if I had showed you that slide, that would show you that 25 to 54-year-olds are actually at a higher labor force participation rate than pre-COVID. And the reason that there is a shortage of labor is that there's people over 55 have left the labor market, and they haven't come back. And that segment of the population is also growing. So that is the structural labor shortage, and that is not going to get solved anytime soon, which is why I personally do not think that the return to office is going to be at the same level it was. We're going through a structural change in the office market as well. Okay, so that's that. And this is one of the best graphics I've seen in terms of like where people move to, because if it's all the green and blue, that's where people move to: the Southeast, Texas, Florida, and the Mountain West. So these migration corridors will continue because they're based upon sort of openness to the economies, but at a slower rate than in the past. All right, now when we look at, now we're shifting to the housing market, that run up in interest rates and a lock-in effect of the existing homeowners in 20 and 21 meant that there was very little supply of homes. And so home prices didn't come down, interest rates costs did go up. So even as we have this ahistoric movement in rents, you're still way more cost effective to rent than to own, way more. And even a slight decrease, you'd have to have a massive increase in supply, which you may be seeing in Texas and Florida. But apart from Texas and Florida, there's not enough single family inventory to come into the market to bring home prices down. So Texas and Florida, you may see some sort of disruption in the single family home market, but apart from that, not, which means that this gap is a big deal and has not gotten better, which is why multifamily results have exceeded expectations and absorption has been better than expected, because you just haven't had the movement out into the single family market. And also why the single family rental business has done pretty well. So this is just a question of what the gap is. The gap's big. It just depends on how big it is by city. And then this is what I was mentioning before here. If you look at that blue line to the left, that is the ahistoric movement in rents around COVID. Right? Consumer welfare did not go down in 21 when people from high-income areas moved to lower-cost areas. It was in 2022 when that was transmitted to renewals. It was where consumer welfare in the existing Sunbelt cities took a hit, and where we're still living through the political ramifications of those increases, even as new supply is hitting and mitigating increases in those same markets. But now you can see here rents have kind of nationally kind of leveled out, but again, it's kind of concentrated. Now, this is kind of an interesting graph for me because it kind of says month to month to month, how do markets perform, right? And you can see how unusual 21 and 22 are. I remember when the numbers were coming in, and I couldn't believe them. Like, it was like, no, this can't be real. I've never seen anything like this, because the normal year, and 2018, 2019 were kind of normal years, you see some movement seasonally, but you don't see anything like this. And so we're now actually back to, in the face of a historic supply delivery, which is truly unprecedented, you're back to sort of normal-ish seasonality, normal-ish seasonal patterns inside of a year. September's numbers came in kind of like a negative 0.2 across the whole country. You're in a normal year, but a normal year in the face of unbelievable supply. And the absorption actually has been really quite good, given the amount of supply that's actually hit the market. So the pattern here, I kind of split this out. Rented by necessity is our definition. I'll call it Class B-ish. Lifestyle would be your Class A. And this is a very typical pattern, right? That actually lifestyle pops up in the beginning of a cycle, and then as the supply comes in, it always underperforms. And if I actually had this chart back to '04, you would see that in general, renter by necessity rent performance has actually far exceeded the upper end, far exceeded it. And so we're in a normal pattern where the rent by necessity rents are continuing to grow even as rents are declining at the upper end of the market. It takes a tremendous amount of supply at the upper end to impact asking rents and rent by necessity. So Austin, Phoenix, there's just a few markets even today where rent by necessity rents are, asking rents are coming down, asking rents. And so this is overall classes, and you can see this is the combination. So yes, you are seeing the impact of new supply on new rent performance. Dallas, Nashville, Tampa, these are all the usual suspects, as it were. San Francisco is more of a demand issue than it is a supply issue. Those issues have still not been sorted out, particularly in downtown San Francisco, which is the only place in the country, I believe, where rents are still not recovered from COVID levels. And you'll see, again, you're seeing in the Midwest and Northeast, those markets are performing relatively well. They haven't had a lot of supply response. They didn't have a huge uptick as much, and they're sort of kind of clocking along. This is a chart I'd love to take a look at, which is what happened between the gateway and the tech hub markets. And Miami acts like a tech hub, and Seattle kind of acts like a gateway. And so you can see, again, with the exception of San Francisco, and it's worse downtown San Francisco, even the gateway markets have kind of sort of recovered, and they're back on generally track. And you are seeing some reduction here as supply hits. But these markets went up a ton. And this is on an occupancy level. This is the impact to the right of all the supply that's hitting for the time being. And some occupancies, particularly in Phoenix, are down 2% from where they were pre-COVID. And kind of where that kind of lays out. Now, as we look forward in terms of our forecasts, we actually see a pop in rents happening at the back end of 2025 and into 26 and 27. That's a big 26 number. And the bottom of it is as the supply wears off, right, and is getting absorbed, there is a whole lot of supply coming behind it, and job formation and job growth is still pretty good, and you basically have a movement upward. So you have, now, I think in a perfect world, life would be 3%, 4% rent growth, and inflation would be at 2%, and everything would be kind of smooth. But we're still having the reverberations come through of the big cycles that happen in the disruption of COVID. But that actually is something that we definitely can see. And if we break this out between sort of where I think the end of the year in 24 ends and then when 25 ends, you can kind of see where some markets will be coming back. There are still markets under pressure, right? But we do see a bounce emerging at the very end of 2025. This is like fourth quarter 2025 numbers. And then 26, 27 doing pretty well. And bottom line is this is the 26, 27 hole in new deliveries. And that's actually, if you look at sort of where actual starts are hitting and the rest of we kind of track the whole supply pipeline, it's pretty clear that you can see this thing kind of rippling through. We actually know where all the projects are. We know where the markets are. And so we saw this surge coming in 2022. You can see the decline coming in 2026 unless there's some sudden change in capital market conditions. 28 and 29 is our expectation that things kind of recover in terms of the ability to do new developments, but 26 and 27 are pretty much locked in. So that's not going to change. And then we actually break this out. We track 5.5 million new supply properties and kind of cycle all those way through. The under construction ones, those are coming out of the ground. Those are going to get delivered over the next 2.5 years. The planned, those have an approved plan, but they haven't got financed and they haven't actually poured a foundation. So it's unclear how much of those get done. And the perspective, which is the big nut, are folks that people would like to build, but they don't have an approved plan. They don't have money. The numbers don't work. And so that's probably an eventual pipe dream. And so there are some markets that are going to deal with some heavy new supply over the next couple of years. And then these other markets, these things may get built over 4 or 5 years. So we track that, and it's pretty well known. So the supply side is pretty much understood. So will the housing shortage eventually get resolved? I think maybe over 10 years. You need 450,000 units over 10 years every year. That's kind of unlikely that that's going to happen, but that's what it would take to resolve a housing shortage. So I don't think that's really likely to happen, but that's what it would take. Now, if you lay this out over, let's say, five-year time frame, and it's percent of stock, so the bars represent the actual number of units to be delivered over a 5-year period. The percentages are the percent of stock to be delivered over each year, right? Those aren't scary numbers, right? Even Austin at 5% isn't scary, and that's probably one of the worst of it. It's just that it's front-end loaded, right? Because the back end isn't going to happen. So eventually these markets, Charlotte, it's a 4.9 number, right? These markets will recover, Raleigh, Nashville. They're great markets, they're great economies. They're going to go through a short-term disruption. They're going to recover. And so I kind of see that kind of from a longer-term perspective. There are some markets short-term over the balance of this year and through 25 that have so much supply coming that if there are going to be problems, this is where you're likely to see that. And there are certain very sort of conditions under which stress or distress is likely to emerge. Construction loans, things bought at the top end of the market, done with variable rate debt, with with debt funds, with poorly capitalized sponsors. So you can see that there are situations, and I do have clients who are getting deals done. Again, it's not a river of blood, it's a trickle. There are problems that do need resolution, but they're not like massive problems. And even the financial institutions themselves know that eventually these things will work out. They're not taking reductions to the debt. The equity might get wiped out in some cases, but not the debt, because they know there's inherent value in the assets, and they're saving their reserves for office. So that's how this is kind of playing out. And you can see this, we actually also track the fully affordable world, and you can see the total amount of stock that's going to get delivered in these markets. It's a lot of stock. So, again, the issues about new supply are kind of 15 to 20 markets around the country. We cover 180. So there's 15 to 20 metro areas where there's a fair amount of supply that's coming in that needs to get absorbed. There will be some sort of, I'll call it isolated pain, but even in these markets, and this is the part that's really quite interesting, we actually have data on what's called trade-outs, which is paired lease transactions. And if you look at even in these markets, renewals are positive. So yes, new lease trade-outs are negative, and sometimes in a meaningful amount, Austin -9. That is true. But renewals have still been going up. So overall cash flows to those properties, now expenses have been going up as well. There's no question about that. So in some cases, we are seeing markets where the NOI is down. But it's not a lot. It's not everything. But the reason that stress or distress has been sort of slow to emerge is partly, sorry about that, partly due to these issues right here. Okay? And despite my voice almost going away, I hope I stayed within the time frame. Thank you all very much. Good.
Thank you, Jeff. I'm glad you made it to the end.
Made it to the end, really. Now my voice.
You petered out, right? But you made it.
Okay.
Oh, I lost my clicker. Here we go. All right, let's zoom us ahead. Oops, back. Okay, well, Jeff hit on a lot of really great themes that I know we've mentioned before, but it's always nice to have an expert come in and add validation to what we talk about. We're going to switch back to our portfolio and talk a little bit about our debt on our funds. Let's switch to the next slide. Okay, so we have 24 loans across Fund 5 and 6. 3 are fixed, the balance are floating rate. The loan to value across our portfolio is 65%. Both Fund 5 and 6 have strong debt service coverage ratios, or DSCR. Lenders typically require at least a 1.20 times DSCR, both Fund 5 and 6 exceed this threshold. And in addition, we have term on our loans. And for the loans that we're coming up to closer to maturities, we're working on extending that term. We're always actively monitoring our portfolio, constantly looking for ways to improve performance, capitalize on opportunities, and provide extra downside protection. Last year, with the rapid shift in interest rates, we were hyper-focused on maintaining duration for our property loans and extending our duration on our interest rate caps. And our key objectives were to stagger loan maturities so they don't all mature at once, securing loan terms that give us the flexibility to hold longer or sell earlier, and achieving all of this while protecting cash flow, ensuring smooth property operations, and maintaining economic efficiency. And to execute on the strategy, we did a deal-by-deal analysis of all the properties in our portfolio, and we bucketed them into two groups, our near-term maturities and our longer-term maturities. For our near-term maturities, these were loans maturing in 2025 and into early 26. This group had 4 loans, 3 in Fund 5 and 1 in Fund 6. And they required additional loan term and extended interest rate caps. We've already completed this work, and we did it either by exercising extensions or refinancing the loans and extending our hedges. On the longer-term maturities, these are loans maturing in late 26 and beyond. There's 12 loans in this portfolio, or in this group, 8 of which are in Fund 5 and 4 are in Fund 6. For these, we extended the duration of our interest rate caps, largely using funds held by the lender. This helped us reduce our monthly escrow requirements, improve property cash flow, and it sets the stage for us to restart our distributions in Fund 5. The Fund 5 loans are substantially complete, and for Fund 6, that debt service coverage ratio I mentioned on the prior slide, that's at a portfolio level. There are a few assets in that portfolio that have tighter coverage, and for those, we're working on resizing the debt to provide a healthier capital stack, in addition to securing additional loan term. We're in the middle of this analysis, and by the middle of next year, we should have a property-by-property plan of how we're going to execute on that. When we get into each of the funds, we'll unpack that a little bit more. These graphs represent where we stand today with our extended debt maturity schedules for both Fund 5 and Fund 6. We're still finalizing one large loan in Fund 5 for Strata Apartments in Phoenix, which matures in 2026. And we're completing the analysis on some of the initial Fund 6 investments that were acquired at the peak of the market. As a result, some of the larger bars, 2026 in Fund 5 and 2027 in Fund 6, may move out on that timeline or be potential properties that we may sell. This slide highlights the interest rate protection we've secured through our hedge extensions we completed last year. As you can see, the forward SOFR curve, which is that dark blue line, is expected to drop pretty significantly by the end of next year, so that compresses a little bit of that interest rate savings. But these hedges act as a critical insurance policy for our portfolio. And they protect us from huge fluctuations in interest rates, and it's something we will always have in place for our floating rate loans. With that, I'd like to invite my partner, Allison Bradshaw, up to talk about Fund 5.
All right. Okay, thanks, Jen. So turning to Fund 5, our portfolio here continues to be well positioned. The original portfolio consisted of 25 properties, totaling over 6,500 units across 12 different MSAs. We have now sold 11 properties and have 14 properties remaining in the portfolio. Our focus over the last year has been on operations and managing flexibility and liquidity across the entire portfolio. However, we are starting to turn to offense. We believe the capital markets have largely stabilized and are working on positioning assets for sale. We have our suburban asset in Chicago on the market and are looking at other potential sales over the next 12 to 18 months. We have ample liquidity at the fund level and one strategic refinance to complete over the next year. We are in the position to recommence distribution and reduce cash held at the fund at year end. We feel that we are largely through the extreme volatility that hit our business as a result of the Fed's rate hiking cycle. We will likely hold some assets longer than originally anticipated, but we have positioned the portfolio so that we can afford to be patient and time sales to maximize returns. So despite the recent pressures from supply, the existing active portfolio has experienced solid growth. Inception to date, revenue has increased 34% and NOI is up 40%. These growth rates are similar to prior vintage funds and show that underlying fundamentals have held up. Inception to date values for the active assets, both at the property level and investment level, are up 20%. So turning to same store performance. Our expectation for 2024 was that supply was going to impact rent growth. Effective rent growth increased 3.4% year over year, down from 7% in the 2023 calendar year. We continue, similar to as Jeff talked about, see positive lease trade-outs on renewal rates and are flat to marginally down on new lease trade-outs. We remain focused on keeping our properties well occupied and increased occupancy by 60 basis points to 93.1%, resulting in overall revenue growth of 4.8%. We expect more of the same on the revenue front over the next 9 to 12 months as supply gets absorbed. But we are set up for a rebound in the latter half of 2025 and into 26 as the supply pipeline is choked off. The expense side has continued to be challenging. Expenses are up 10.3%, primarily driven by a few line items, which I will discuss in detail. Overall, though, NOI is up 1.1% for what is now a primarily stabilized portfolio. And despite our conservative debt strategy, we are still seeing the impact of increased debt costs. Cash flow after debt service increased 7.2% year over year, but the impact of debt costs has largely been absorbed, and we expect this to normalize over the next year. The key takeaway remains: operational fundamentals in the multifamily space remain steady, and this portfolio is healthy. Okay, so let's talk a little bit about expenses. On a percentage basis, our largest increases were driven by admin expenses, turnover, and insurance. On the admin side, this largely reflects increased costs with processing evictions on non-paying residents. Turnover costs has increased as we've held some properties longer than expected and also saw a large number of units returned from non-paying residents that weren't in the best condition. But the bad debt trend is trending in the right direction. 2023 bad debt was 2.4%, and year-to-date through August, bad debt is 1.6%. We therefore expect both admin expenses and turnover costs to normalize over time. Insurance is a big one. As all of our renewals have rolled on, we saw a 65% increase in insurance expense. We are already starting to see relief here. We have 15 policies that renewed in 2024 across both funds. We saw an average decrease of 23% year over year. We're hopeful that on a blended basis, insurance will be flat in 2025. I will caveat that with the fact that we'll have to see what happens given these recent hurricanes. All right, so as I mentioned, we've sold 11 properties to date. The majority of these sales were executed at the peak of the market in 21 and 22. As shown here, we locked in really excellent returns for those first 9 properties, outperforming underwriting. As the Fed undertook their tightening cycle and rapidly increased interest rates, the markets became super choppy. 23 and 24 were very difficult markets to sell properties. Greg will cover this in detail later, but transaction volume was down significantly over the last 2 years. Our last 2 sales were strategic defensive sales. We are not happy with the return on either sale, but particularly Apex Royal Oaks. However, the best path forward on this property was to exit. Post-COVID, this Houston submarket really changed for the worse, and the tenant base and reputation of this area made operating in this market over the longer term very difficult. But even when taking into consideration these 2 last sales, our realized net profit was $138 million, 48% above our underwritten net profit of $93 million. For the balance of the portfolio, we don't have any pressure to sell, but we're hopeful to be much more active on the sales front in 2025. We do have 1 asset currently on the market, Valley Low, our Chicago property. We've owned this asset for 6 years, and the property is having its strongest performance run we've ever seen. Strong occupancy, double-digit rent growth over the last 4 months, so really well positioned. Given the lack of supply in Chicago and stronger near-term rent projections for this market, investor demand is higher than usual, and we're hopeful that this sale moves forward in the first quarter. So where do we stand on the total portfolio? We've realized 35% of the portfolio, distributed approximately 68% of total invested capital, or $207 million back to investors. In addition, we have $27 million, or 8% of the total fund, held at the fund level in cash reserves. This capital was reserved in an abundance of caution, given the uncertainty in the capital markets over the past year. We'll talk about our plans for this capital in greater detail later in the presentation. We do have 65% of the portfolio remaining to sell, but our early sales lock in a significant portion of the fund's overall returns, and as Jen touched on earlier, ranks us high relative to other peer funds on DPI, or distributions to paid-in capital. The 11 properties we sold resulted in a gross investment level IRR of 31.6% and strongly outperformed our underwritten returns. Okay, so back to supply. Wanted to take a moment just to talk about some of the supply headwinds we're facing in some of our markets. We invested in great markets with strong demand drivers, and others saw those same demand drivers, and developers rushed in. At the end of the day, it's always about this, supply and demand. We have a handful of markets where peak supply is really hitting over the next year, and then it declines substantially thereafter. But Raleigh, Phoenix, Charlotte, Nashville all have 10% of existing stock forecasted to be delivered over the near term, and then deliveries really fall off a cliff. As a positive counterpoint to the new supply, we have seen exceptionally strong demand in the first 2 quarters of this year. In fact, the first half of 2024 saw the same demand for apartment units as the entire year of 2023. We are hopeful that demand continues to match supply, but recognize that rent growth will be modest over the next year in several of our markets. But after we get through this supply wave, these markets will be very well positioned for outsized rent growth in the latter half of 2025 when supply additions are very, very low. There we go. So given that we will likely hold longer in select markets, we've been going through our portfolio asset by asset and assessing our existing debt term. Fund 5 is largely repositioned. To hit on 2 case studies, on Paseo Park, one of our Phoenix assets, we've been holding operational cash flow at the property. We have 10-year debt on this asset. We've extended our rate cap until May 2026. This allowed us to reduce our monthly required escrows and increase operational cash flow at the property. We funded the cap purchase through lender-held escrows and cash flow. We now have additional term on our hedge, have term on our loan through 2031, and are well positioned to hold the property longer than our original projected hold period. Strata is another Phoenix asset. This was one of our last Fund 5 acquisitions. We financed this asset with a 5-year Freddie Mac loan. We anticipate this will be one of our last Fund 5 sales. And current projections assume we sell this asset in 2028, which is beyond the current loan maturity. Operationally, the property is stable, cash flows well, but from a sizing perspective in today's rate environment, it does need to be deleveraged, and we need more term to be able to sell into better market conditions. Last year, when we looked at a potential refinance on this asset, given where rates were, we expected the fund would need $17 million to deleverage the property. If you look at the bottom right, rates have come in around 100 basis points on the 5-year. I mean, today this is probably closer to 65 bips, but this is greatly improved what the refinancing looks like for this property. We have a quote in hand that requires a roughly $9 million pay down from the fund. We're working through when the right time will be to move a refi forward, because we still have 2 years remaining on this loan. But this asset was the primary driver for us holding cash and maintaining liquidity at the fund level. At this time, we have a much better insight into the cash needs at this property, which are much lower than we expected, and we will distribute a large portion of the cash held at the fund at year end. At our call in March, we communicated that we had largely absorbed the decline in valuations off the market peak. We relayed that valuations could start to see improvements as interest rates came down over time. This has turned out to be true. Quarter over quarter, Q2 saw improvements in both property and investment values. And it's never easy to call a bottom, but this certainly feels like this is it. We expect to see slow and steady continued improvement in the coming quarters, and if interest rates follow the Fed's current guidance. Additionally, Fund 5 investment valuations are 19.8% ahead of acquisition values. And after sort of veering off course due to interest rate changes, portfolio values are largely back in line with their original growth trajectory. So through the implementation of each business plan, we have been able to meaningfully move operations since acquisition. For the active and remaining portfolio, we've invested $68 million into our properties on capital improvements, and we've increased NOI 40.3% since acquisition in 3.7 years. In terms of projected returns, we continue to refine our forward-looking assumptions. The main input that we've changed is the timing of our sales. Our expectation is that the sales market comes back to life next year and into 26. We plan to hold some of our later acquisitions longer, with the last sale currently modeled as selling in 28. With these assumptions, we're projecting a weighted average IRR of 10.7% and an equity multiple of 1.6 times for those remaining 14 properties. Certainly, if interest rates move down more quickly, we could outperform these projections. That will blend with the realized returns that we locked in, which were at 31.7%. From a debt perspective, the remaining assets are well positioned, limited near-term maturity, longer-term hedges in place. Projections do assume the deleverage of Strata and using a portion of our reserves, refinancing that asset so that we can hold that property longer term. So how does that translate into overall fund return projections? To date, we've distributed a total of $207 million to investors, including sales and operational cash flow. Original target returns for Fund 5 were a 12 to 15% net IRR and a 1.5 to 1.7 times net multiple. Our expectation is that between realized investments and the remaining portfolio, we will be in the 14 to 16% net IRR range and a multiple within our original target. At last year's annual meeting in October, the outlook was foggy at best. We had significant supply ahead of us in many of our market. The Fed's still hiking rates to fight inflation, which created a lot of volatility in our sector. And of course, there was the prospect of a major recession. Today, the picture is clearer. Capital markets have stabilized over the last couple of months. More properties are being listed for sale. We're not seeing that extreme rate volatility that we've seen since 2022. And the jobs market has largely held up. We have addressed the majority of debt needs at each property and have a good handle of capital requirements at the last remaining asset. We held capital at the fund level out of an abundance of caution for downside protection. However, we intend to recommence distributions by year end. Our team and senior leadership remains extremely focused on asset management, and we're working to position a number of the properties for sale in 25 and hope to be an active seller over the next years. Overall, Fund 5 is well positioned. We've locked in a strong realized base to help achieve our target returns, and the remaining portfolio is comprised of great properties in really strong markets, and we'll work hard to maximize returns at these assets. We now have a short case study of Park West End, which really will highlight what we do on the ground level at our assets.
My name is Brian Cohn, and I'm Vice President of Asset Management at LEM Capital. Today, I want to present a case study showcasing our value-add business plan execution. I'll be discussing one of our Fund 6 assets, Park West End Apartments, located in Richmond, Virginia, which we acquired in 2021 with McCann Realty Partners. This acquisition marked LEM's fourth investment in the Richmond MSA. We have continued to be impressed by the steady, stable, and increasingly diversified economy. A testament to LEM's conviction in this market has been the continuous ownership of at least one asset in each quarter dating back to 2016. Based in Richmond, McCann Realty Partners has extensive experience investing in and operating multifamily real estate in the area. LEM and McCann have a long-standing relationship and track record of strong performance, with the acquisitions of Fund 4's Discovery on Broad in Durham, as well as Fund 5's Discovery Gateway in Atlanta and Courthouse Green, also in the Richmond MSA. Richmond's growing job base, low cost of living, vibrant neighborhoods, and central location have led to the area becoming a desirable place to live. Virginia, and more specifically, Richmond's favorable business climate attracts corporate relocations and expansions due to its low cost of doing business and ability to cater to a highly educated workforce from nearby universities. The MSA's diverse economy features major employment drivers, including an expansive regional healthcare industry that boasts several nationally recognized hospitals, the corporate headquarters of 8 Fortune 500 companies, and a major presence by Capital One as the second largest private employer of around 13,000 people. Lastly, as the state capital, Richmond's public sector serves as an employment anchor, comprising 16% of the region's total workforce. This economic diversification, along with the market's relative affordability, has helped insulate Richmond from the recent economic slowdowns and made it a popular alternative to the more expensive Northern Virginia submarkets. Market occupancy remains strong at 95%, with unemployment in the top 5 of large MSAs at just 2.5%. Forward 5-year rent growth projections also rank in the top 10 of major MSAs. Park West End is conveniently located in the heart of the Northwest Richmond submarket, with direct access to West Broad Street and I-64, offering residents unparalleled connectivity to Richmond's bustling downtown and West End job nodes. The property is just 6 miles southeast of the 630-acre Innsbrook Business Park, which encompasses 8 million square feet of Class A office space and is home to over 22,000 jobs. Just a few minutes further west is the Short Pump Town Center, a premier open-air lifestyle destination with over 120 shops, restaurants, and entertainment options. The I-64 corridor has been a key path of growth in Richmond, and because Park West End is centrally located between downtown and Short Pump, it has benefited from an influx of renters looking for well-maintained and affordable housing options, with easy connectivity throughout the area. Due to Richmond's strong apartment demand drivers and projected growth, it has always been a target market for our strategy. When we began assessing Park West End as an investment opportunity, the significant management and physical upside quickly became apparent. Previously owned and managed by a California-based investment firm, the property had endured years of neglect, resulting in poor physical condition and in-place rents several hundreds of dollars below nearby competitors. The lack of investment by the prior ownership created an opportunity to add considerable value through a comprehensive exterior and interior capital improvement plan. We were able to leverage McCann's local knowledge of the MSA and submarket to inform our underwriting, while maintaining conservative assumptions with areas to outperform. For example, we worked diligently with McCann to formulate an optimal interior renovation scope catered to the area's renter demographic and the submarket's competitive set, while capping our underwritten annual rent growth assumptions despite the submarket being supply constrained. Even with this conservative approach, we still saw the projected value of the acquisition and potential upside as a unique opportunity. Park West End is a garden-style community with 26 two-story residential buildings constructed in the mid-1980s. Spanning 18 acres, the property contains 312 units, featuring attractive design elements including efficient floor plans with open kitchens, and an amenity footprint that could compete with newer apartment product in the submarket. Despite these elements, at acquisition, the clubhouse, amenities, exterior paint scheme, and unit interiors were dated and uninviting. Our business plan contemplated a broad improvement scope to make the property look and feel like new construction, but at a much lower price point. Our value-add plan began with the initial drive-by of the property. We capitalized on the frontage along Glenside Drive and Bethlehem Road by enhancing the signage and landscaping to elevate the sense of arrival and make the property more welcoming. A fresh paint scheme and modernization of the balconies breathed new life into the formerly tired exteriors. Next, we focused on the expansive amenity set, starting with the clubhouse. We took the formerly outdated and underutilized space and added modern design elements to provide a more contemporary feel. Arriving at the main entrance, residents enter through the leasing center. Here, we added a more defined seating area and visually appealing shiplap wall element. Throughout the clubhouse, we updated the flooring with high-quality plank that complements a new color scheme. Moving into the resident lounge, we added modern decor and renovated the kitchen to a high-end scope to create a more inviting space. In the rear of the clubhouse, the fitness center received an upgraded equipment package designed to help residents achieve all their fitness goals. At the pool, we resurfaced the pool deck and removed a rotted wood seating area to add additional green space and soft seating. A grilling station next to the pool overlooks a large amenity area. We resurfaced the sport court, keeping the basketball section and adding areas dedicated to pickleball and picnic benches. The dog park was relocated to the far side of the courts to make way for a large lawn area. In the units, our goal was to offer the design elements and aesthetic of newer properties, but at an affordable price point. Our comprehensive interior renovation plan sought to create a cohesive, upgraded finish from what was previously a mix of classic and lightly renovated units. In the kitchen, the final interior scope features a subway tile backsplash, stainless steel appliances, and shaker-style cabinet doors with painted boxes. We lowered the bar height counters and installed a single piece of granite countertop with undermount sinks to open the kitchen into the living and dining space. Throughout the unit, we removed carpeting and installed vinyl plank flooring, which adds a contemporary feel found in higher-end properties. Every unit received a washer and dryer, where previously there were just connections in certain apartments. As of May 2024, about 2.5 years into our investment hold period, we have increased in-place rents by over 36%, translating to NOI growth in excess of 64%. Our average in-place rents of $1,403 offer a 7% discount to the broader Richmond market. As we continue to monitor the MSA for new opportunities, Park West End remains a testament to LEM's disciplined approach to acquisition sourcing and business plan execution with one of our leading operating partners.
So hopefully you all enjoyed the case study for Park West End. You can hear us talk about the properties and the renovation programs all the time, but we think it's helpful to bring them to life with some visuals, so hopefully everyone enjoyed it. So turning to Fund 6. To date, we've invested $217 million in 10 properties across 9 MSAs, with one additional property that's been approved by investment committee and is currently in due diligence. Similar to our last 2 funds, once fully invested, we expect it to be a geographically diverse portfolio of 20 to 25 properties in strong growth markets across the United States. We remain focused on high growth markets with business-friendly economies and high barriers to entry. The blue dots represent investments made at the peak of the market. We've only invested 48% of the fund's capital, and at the end of the day, 2/3 of this fund will be invested post-peak after values recalibrated. I agree with my partners Allison and Jen, who mentioned earlier that we're now at the bottom of this real estate cycle. Fund 6 is extremely well positioned with the remaining $234 million to invest in what we think will be an ideal time to be an active buyer at the beginning of a new cycle. With Fund 6 just under 50% invested, a majority of the remaining capital will be utilized to find unique opportunities to round out the fund with another 10 to 15 properties. These investments will be acquired as we enter into this new market cycle and will greatly benefit from the rent growth and value rebound we're expecting over the next several years. We will likely hold several of the earlier acquisitions acquired at the peak longer than originally underwritten. We're actively working on a plan evaluating each of these early investments on a deal-by-deal basis, and we anticipate utilizing approximately 8 to 10% of the fund's total equity to deleverage several of these investments, swapping debt for equity. This will allow us additional time and flexibility to restart the business plans, to stabilize the properties, and optimize our sale timing. Park West End, we just saw the case study. It's also a great example of one of these deals where we're working through on a deal-by-deal basis. Operationally, the property has performed extraordinarily well. NOI has increased by 64% since we acquired the property in December of 2021. And although we still had 2 years of term remaining, we proactively approached our lender about extending our maturity date. And quite honestly, it was kind of tough to get their attention at first because they figured they had 2 years of term left and it wasn't at the top of their list. But for us, we're always focused on protecting our downside and being proactive, so we thought it was in our best interest to approach them. So we were successful in negotiating a modification to extend the maturity through January of 2028, adding 2 years of additional term. This modification required no principal paydown. We did purchase an extended rate cap, and we gave up 30 basis points on spread. But overall, this was a great outcome for the fund, providing flexibility to work through our business plan and eventually sell the property on our terms when capital markets have fully stabilized. Taking a step back, Fund 6 had its final close in August of 2022. We're still early in the fund life. This gives us plenty of time, well into 2030, to be patient and accomplish several different things. Firstly, to season and stabilize the earlier investments. Secondly, to work very hard to maximize output on several of those earlier deals that do have some value pressure. And finally, and probably most important, to invest the remaining majority of the fund into deals at an attractive basis with an exciting story and the opportunity to outperform. While we do have time left with the fund life, the overall multifamily transaction market has been very slow the past 2 years, which we'll discuss in greater detail in a few minutes. But with that said, transaction velocity is accelerating, and we're very confident that we'll be able to identify strong investments to round out the fund over the next 12 to 18 months. This would put us slightly beyond our investment period, so we might need a bit more time to finalize the portfolio. But we're excited about the increase in transactions across the market and our growing pipeline. Across the portfolio, we've generally slowed renovation programs to focus on occupancy as we manage both seasonality and new supply across our markets. Consistent with Fund 5, as Allison discussed, We have continued to see pressure on the expense side, driven by increased labor costs, both at the site level and for various contract services. We've also seen significant increases in insurance costs, but always proactively working to manage these expenses, and we're monitoring very, very closely. And we're starting to see some of these expenses start to stabilize. With that said, to date, the Fund 6 portfolio has increased by 22%, with an average hold period of just under 2 years. This is a tremendous amount of growth over a very short period of time, and we're very proud of those results. At this point, we've absorbed the decline in values for our earlier investments. Consistent with LEM's overall focus on downside protection, we value our entire portfolio on a quarterly basis with a conservative and transparent approach. As a reminder, the decline in values we observed was not because we invested in inferior properties in bad locations. On the contrary, the active portfolio consists of well-located quality assets, and we have generally seen strong operational performance across these deals. The decline in values was driven by the swift and unprecedented change in interest rates over a very short period of time. Also, let's not lose sight of the fact that we don't yet have a complete portfolio. A majority of the value declines Fund 6 experienced were attributable to deals that were acquired at the peak of the market, which will end up comprising less than 1/3 of the total fund. We have similar exposure to deals acquired at the peak in Fund 5, but that fund is fully invested and has the benefit of being invested over a longer period of time. These value declines were just as of this point in time and are affecting the entire real estate industry as a whole, not just LEM. We are confident that we are now on a positive trajectory regarding valuations. The 10 properties we've acquired to date for Fund 6 are strong properties in strong locations with best-in-class operating partners. We continue to stress our focus of hands-on asset management and remain nimble with the strategy for each asset. We evaluate each business plan on a regular basis and can accelerate renovation programs quickly if we see the market demand supports them. You'll see one new deal on this list, Trail Ridge Flats and Townhomes located in Boulder, Colorado. The Boulder market benefits from limited new supply, a diverse employment base, and overall strong demographics. This is our first deal with operating partner Two Arrows Group, and we are off to a great start. I was actually just at the property 2 weeks ago, and we're well underway in executing the value-add business program and implementing professional management. The existing portfolio is well-positioned to capitalize on substantial rent growth that we're expecting once the wave of new supply is delivered and absorbed. We have continued to be patient, waiting for the right opportunities to round out the portfolio, and this has been strategic and deliberate. Nationwide, multifamily transaction volume for the first half of 2024 decreased by 28% year over year and was 75% below the first half of 2022. Transaction volume still sits well below historic averages. Limited volume over the past 2 years really has been driven by several factors, including continued volatility in the interest rate environment and a general lack of willing sellers with a bid-ask spread that remained wide. This spread has started to tighten, and we're enthusiastic that this will lead to greater transaction volume and unique and storied opportunities. Transaction volume is starting to pick up. Across the market, there's a renewed sense of optimism leading into the fourth quarter and beyond into 2025. The Fed started easing in September with 50 basis point rate cut, with additional rate cuts expected before the end of 2024. Agencies still are active as the most reliable and consistent source of multifamily debt, but we've started to hear from alternative lenders slowly but surely coming back and becoming more active and more competitive. Over the next 12 to 18 months, we expect that new supply will be absorbed and interest rates will stabilize or go down, and this will create a very favorable environment for us to deploy the remaining capital for Fund 6. And this energy and momentum is really starting to take hold and be reflected in our pipeline. As always, our pipeline is comprised of deals sourced from multiple angles: marketed deals, off-market deals, and recapitalizations brought to us through our operating partner network. We continue to be focused on deals with the same characteristics that we always have been focused on: high growth markets with business-friendly economies and high barriers to entry, multiple drivers for increasing value and improving operations, both from a management and physical perspective, good schools, strong transportation systems, markets like Boston, Nashville, Orlando, Denver, and Phoenix. We still do expect to see a portion of our pipeline come from stressed or distressed deals, but to date, lenders have been willing to work through most issues with their borrowers. And for those that do or that have become actionable, the quality or the current state of the real estate has simply just not fit our acquisition criteria. But this is certainly an angle that we're going to continue to monitor and track as we move into the future. As I mentioned earlier, investment committee has approved a deal in the Sacramento MSA called Fairmount at Woodland. Fairmount at Woodland sits 20 minutes west of the Sacramento International Airport, 15 minutes north of Davis, California. This will be LEM's 5th acquisition in the Sacramento MSA and 21st acquisition with one of our longest standing operating partners, Benedict Canyon Equities. Our other Fund 6 property in the metro, Azure Apartments, has recently experienced some of the best lease trade-outs in our entire portfolio. So we've seen how strong the market has performed over the course of the last 6 months. The property was acquired at an off-market, will be acquired on an off-market basis from an unsophisticated, out-of-town owner, and the property is extremely undermanaged relative to the competitive set. LEM and BCE had been tracking the opportunity for nearly a year, and BCE's relationship with the seller enabled us to come to terms at a very attractive basis without competing through a full marketing process. Sacramento has very limited supply pipeline and significant barriers to entry, leaving housing in short supply, which creates favorable operating environment for us to execute our business plan. Nearly the entire property units, all the units of the property are in classic condition, and our business plan contemplates installing washer and dryer connections and undertaking a fairly substantial interior renovation program, including cabinet fronts, flooring, kitchen countertops, and appliances. Additionally, exteriors of the buildings will be painted and the property will be rebranded. The amenities have a solid existing footprint, but will be reprogrammed and renovated to maximize each space. So we're very excited about both the physical and management upside at this property and our ability to tie it up at an attractive basis and a very attractive cap rate. So looking forward, we anticipate a capital call in the fourth quarter of approximately 3 to 5%. From there, the remaining capital will be called throughout the balance of 2025 as we identify new investments for the fund. As we mentioned, we're actively working on a plan to deleverage and hold certain assets longer than initially underwritten. And as a result, as Jen mentioned earlier, we've made slight adjustments to our expectations for the fund's targeted returns. We now believe that a net IRR of 10 to 12 and an equity multiple of 1.5 is a realistic scenario for Fund 6. With that said, there are several factors that could drive us to outperform these projections and bring us back within line of our original target range. Firstly, capital markets are stabilizing and improving. We have already started to see prints of marketed deals trading below 5% capitalization rates, well inside our conservatively modeled exit projections. Secondly, the construction pipeline is slowing and coming to a halt, which creates an environment for outsized rent growth. And finally, we've only invested 50% of the capital for Fund 6, and we're excited about the buying opportunities that lie ahead. We remain focused on driving the performance for the existing portfolio and proactively asset managing each investment to manufacture yield and optimize returns. Although we continue to practice patience, we are ready to be aggressive when interesting opportunities at attractive pricing emerge and what we believe will shape up to be a great time to be a liquid investor at the beginning of this new real estate cycle. So the LEM team remains laser focused, and we appreciate your confidence in Fund 6. So with that, I'd now like to invite Jen back up to the podium to wrap up our conversation for today.
Thanks, Greg. As we wrap up, I just want to highlight a few key takeaways. First, we're feeling a lot more optimistic than we did last year when we were sat in the same position. At a macro level, it feels like there's some more stability around interest rates, which should help increase deal volume. We like to do deals. That's what we want to do. While there's significant supply in the near term, the long-term fundamentals were still dramatically undersupplied. I mean, as Jeff talked about, we need 450,000 units to deliver over the next 10 years to make up the gap. It's really not that plausible. And even with that, there's still so much demand for this product type. We have 22 years of experience, a really proven track record, and deep industry expertise. We're confident that we're really well positioned to navigate and succeed in this market. And looking ahead to next year, our focus will remain on managing the portfolio effectively, handling our debt strategically, starting to relaunch Fund 5 assets for sale, and deploying the balance of Fund 6. We're really appreciative of everyone's support, and thank you for your time today. So now we're going to open it up to questions. I know we have people online, and we'll be monitoring those questions coming in. But for anyone in the audience, if you have a question, please raise your hand. I'll re-articulate it for those who are online. Brett.
Yeah, so for the assets that you guys are embarking on deleveraging, correct? Thank you. For the assets you guys are looking to delever in the portfolio, how are you guys creating alignment with your operating partners in those business plan changes? Because you're probably likely extending your hold periods, maybe putting more money in. And how do you keep them focused with you guys on the deals in the portfolio that need your attention versus chasing the next deal that could be a lower basis?
It's a great question.
I mean, I think that, well, firstly, I would say that we're very selective with our operating partners, and we're aligned with our business plans from the get-go. And so there hasn't been any, I think everybody is on the same page. So we are in constant communication with our operating partners. And so I think that they believe in the assets. We're re-underwriting them with them as we're evaluating these assets. And I think that they're totally 100% bought into the fact that we might just need a little bit more time to execute on the business plan and buy some more time to sell when the time is right. I would say that across our operating partner network, I think everyone has a few issues that they're working through. But I think the fact that not a lot of all of our operating partners are focused on our assets, and we demand that attention from them, and they give us that attention. And so I don't think there's any issue or risk of not being aligned with them on moving forward, even if it's a couple years beyond our original underwritten hold period.
I just add, so we only do 85-15 deals or more. So that strategy was to make sure that our partners had a lot of equity invested in the deals, and so they would be important to them. So their focus is, I mean, we know partners, we have never done deals with them who did 99-1 deals, and I can guarantee those guys are not focused on their deals that are in tougher spots anymore. But I think that helps create the alignment and focus. And they're very proud of their track records. And I'd say for the 2 or 3 assets that we're focused in on, they're in alignment. We look at what those new dollars go in and the return on those new dollars to make sure that they're accretive. But I've actually been impressed with the focus of our operating partners, on the more challenging deals.
Yeah, I mean, they have, Allison's point is a great point. I mean, they have material, dollars at risk as well. The principles of the firms, not just, friends and family, et cetera, like they have a lot to lose. And so I think that keeps their focus. So structuring that way from the get-go has allowed us to continue to keep their focus through the entire hold period.
Mm-hmm. But it's a good question.
Yep.
On Strata, where you're projecting a $9 million pay down, they're going to come up with 15% of their share of that?
Mm-hmm.
Talk to them about that.
We're in the process of it. And that one, again, we have 2 years to figure that strategy out. And we're going to look at, where the capital markets are and try to, hopefully time it where it even goes down below the 9 million. But yes, they are on board with coming along with us for that and figuring out that asset. And thankfully, most of them want to hold long term. Yeah. No one wants to sell at the worst time. So, they feel a lot better with the strategy of kind of getting to 28, 29, being in a better position to recoup and make a return on their investment.
A question that came in online was, given the current pace of deployment and forward pipeline, when do you think Fund 6 will be fully invested? And I think Greg alluded to it that, over the next 12 to 18 months is when we think we'll be able to deploy the balance of the fund. Pipeline's improving, but it still feels like it's kind of 50% of 2019 volume. And so that puts us into probably the first half of 2026 to be fully invested. A lot of things could change, and that could accelerate pretty quickly. So that's just kind of our outlook today, focusing on the downside.
I would say the deal volume and the deals we brought to investment committee over the last 2 months have been like triple to quadruple what we saw in the first half of the year.
Yeah.
So it's picking back up. So I'm hopeful we'll get into a better rhythm of deal flow.
Matt.
Well, you guys have been doing this for 10 years, and I'm just wondering, like, over the sort of full length of these cycles, do you still believe in the floating interest rate model and not fixing, the float plus caps, or have you changed any thinking in that over the last few years, after the last few years?
It's an active debate we have all the time. But what we really like about the floating rate is the ability the flexibility to sell when you want to sell without a horrific prepayment penalty. I think we'd maybe lengthen our caps longer or really make sure the caps follow the curve so that we at least lock in that minimum. We've always done super tight caps, but even really like at least going below or mimicking the curve so that we can really have confidence in our return projections, but we do like the flexibility. We're actually, right now, one of the problems of the market has been the only thing that works is 5-year fixed rate financing. And the flexibility is not great. If you want to sell in year 3, you have to pay a big, potentially unknown prepayment penalty.
Have you really sold that many assets?
Yeah, a number.
Yeah.
Oh, yeah.
If you look at Fund 5, I think I think that strategy worked out perfectly to have that flexibility. If we would have had fixed rate debt, every single one of those deals, I think every single one of them was had a floating rate loan on it, and this doesn't even. I think Jen's bringing up the sales. That doesn't even factor in the sales in Fund 4 as well, which were all floating rate loans. So when all was said and done, we sold probably $1.5 billion worth of real estate, and timed it within at the peak of the market within a month or two. And if we had fixed rate debt on that, I think it would have slowed us down in our decision-making process. We would have thought twice because of the yield maintenance or the prepayment penalties we would have had to pay. So having that flexibility allowed us to lock in a lot of these returns for Fund 5 and really round out the sales for Fund 4.
A partner in Denver who had a fixed rate strategy that sold a similar amount of real estate over that period, they paid $200 million in prepayment penalties.
Yeah.
And so you gotta, you could do the math and figure out exactly, but this allowed us to be very decisive, like Greg mentioned, on our sales strategy.
Any other questions for the room?
Are there any target markets that are now off limits due to insurance cost or insurance availability?
It's a good question.
We've been talking about that a lot
especially
too.
Today.
Yeah. I would say that there are no markets that are 100% red line, but I think that there are certain markets that we are certainly, more cautious of. I mean, because of insurance or because of other reasons. One example is Houston. It's a volatile market. It's a timing market. There are insurance issues. Feels like there's always seemingly supply issues in Houston. So, I wouldn't say that I would never say never, but I would say it's probably a hard yellow light for Houston moving forward. And we've invested there historically, and we've done pretty well. But it's a market that I would say is a yellow light. Specifically, for insurance, I would say that it's all about part of it is how you underwriting it appropriately. I think for example, for insurance costs, the last 2 years, we've been underwriting insurance escalation of anywhere from 5 to 10%, depending on the market and the time on which we were underwritten. So, it's all the way through. Maybe that's conservative, maybe that's not from what we've seen. But I would say that there are probably more markets some markets that are yellow light, but none that are 100% red light.
I would say though, like within Florida,
Yeah.
our likelihood, a lot of assets are located in a flood zone or partial flood zone. And maybe, we've been talking about, should we just cross those off? And I think that probably will be something we think long and hard about and assess.
And the other thing about insurance is it hasn't just been concentrated in like the obvious places you're thinking, like Florida. I mean, our biggest renewals last year were in Chicago and Nashville. So it's a lot of other things. It's not just kind of where those coastal markets you'd expect. Any other questions? Matt, you've only had 2 today. You always have plenty.
Well, I'm just curious, like on the new deal that's in contract and the Boulder deal, like what? I mean, generally speaking, and like you can talk about it with the value low. Like what cap rates are you assuming?
Yeah.
Are you assuming you're exiting any of these things sub 5 cap?
No, so using the Sacramento deal that's in contract as an example, the acquisition cap rate on our numbers, real estate tax adjusted, is about a 5.3 to a 5.4 cap, and we're underwriting to exit at a 5.75. So we're providing pretty substantial cushion. It's positive leverage day one. We're underwriting fairly modest rent growth, but we're seeing deals trade in Sacramento sub 5 cap. We're actually underwriting. We received underwriting from 2 of our operating partners on 2 deals that are on the market now, very similar to the deal that we're acquiring, and the cap rates there, one's a 4.9 and one's a 5.05. Going in. So we feel pretty comfortable. We were able to buy it on an off-market basis. I think another thing that's a really important factor is it's a 5.3 or a 5.35 with an opportunity to add value and drive that cap rate. So I think our mark-to-market cap rate, our stabilized cap rate, I think is in mid to high 6s. And so it's not only the fact that we're able to buy it at a 5.3, we're able to drive it and create additional value on top of that. So I think that just stands to us being selective and patient and finding those unique opportunities. This is a unique opportunity. It's an out-of-town seller, off-market opportunity. We were the only ones who underwrote it. We were the only ones who got to look at it. And so, and I think Boulder is it's
5.2.
It's a 5.2 cap going in. I think we underwrote to exit that at a 5.75 as well. And so our goal is to underwrite these conservatively, so not everything has to go perfect. To give ourselves some cushion and some room to drive performance and outperform.
And value low, on your underwriting, what's your asking price on a cap rate basis?
It's about a 5.25 to a 5.5. I mean, that's a pretty unique property. It does have the highest rents in our portfolio. On a per unit, it's 1,300 square foot unit floor plans. It's we're more there. The governor is also the per unit pricing there because we're going to sell it for over $400,000 a door. So the cap rate could look attractive at a 5.25 to a 5.5, but I think people are having more issues with with the per unit. But I feel really good about that execution. It's been a great asset, and it's getting pretty good interest so far.
And what about Austin? You bought a deal in Austin a year ago.
Yeah.
When you're on your mark to market, are you sub 5 on that exit assumption?
Not sub 5 on,
5 exit on the Austin.
Yeah, 5 exit.
and that market is trading well inside of 5 right
Yeah,
now.
it's trading inside of 5. And, Jeff pointed out earlier, and we talked about it throughout the presentation, there's a lot of supply in Austin. And we underwrote concessions for the first several years there, for the first 3 years. And so, it's going to be a battle for the first few years, but we believe in Austin long term once all that supply is absorbed. There's a lot of supply, and so it is going to be a battle. But we're still believing the Austin story long term. It's still a tremendous growth market, very business friendly. Long term, I think it's going to be fine. I just think it's going to be a tough go of it, and I think we underwrote it that way. We underwrote 3 years of concessions.
Thanks.
Sure.
Great. Well, if there are no more questions, that'll conclude our formal presentation, and we have lunch for those of you who are in person. Those of you online are missing out up in our offices. But thank you again to everyone for your time today. And feel free to follow up with us if there's any other questions that come to mind later.
Thanks, everybody.
Thank you.